Good day, learners, and welcome to your EMS Lesson 1. Our topic for today is the accounting cycle. What is the accounting cycle? The accounting cycle is the sequence of procedures used to keep track of what has happened in the business and to report on the financial effects of these procedures on the business. It is basically a process where we show when a transaction occurs and how it's moved through different steps until it is recorded in the financial statements of the business. The accounting cycle includes the following 6 steps, which are transactions, source documents, journals, general ledger, trial balance, and financial statements. Let us look at the first step of the accounting cycle. Transaction. What is a transaction? A transaction is a financial action or events that takes place in the business between a buyer and a seller expressed in monetary terms. Learners, we learned in grade 7 that a transaction is a business deal where money is involved. There are different types of transactions that happen in a business every day. For example, we receive money, we pay out money, and we deposit money. So from the moment the transaction takes place, that's the start of the accounting cycle. And this transaction needs to be recorded correctly. This takes us to our step 2 of the accounting cycle. Complete a source document. A source document is used by the business to record transaction, and it's normally completed in duplicate. It is the source of information for accounting records. It serves as proof of transaction. A source document is completed in duplicate because we as a business need to keep a copy for our records, and we have to give the customer another copy as proof of transaction. Examples of source document is receipt, which is our duplicate receipt, cash register slip or cash register tape, bank deposit slip, and invoices from sales and purchases. Let us move to our third step of the accounting cycle. The third step is to record transaction in the journals. Transactions are recorded on a daily basis in the books of first entry, which are CRJ, CPJ, DJ, DAJ, CJ, and CAJ, which are also referred as subsidiary journals. In grade 8, we focus more on the CRJ and CPJ. CRJ is cash receipt journal, and it records all the money received by the business. CPJ is cash payment journal and records all the money paid out by the business. Journals need to be casted and cross-casted at the end of each month, which means they need to be added up or totaled at the end of each month. Let us move to step 4 of our accounting cycle, which is to post to the general ledger. Posting is the act of transferring information from journals to appropriate accounts in the general ledger. The general ledger have 2 main sections, which is the balance sheet account section and the nominal account section. The balance sheet accounts are balanced, while the nominal account totaled at the end of each month. So after recording the transaction to the journals need to be summarized or totaled and posted to the general ledger. The general ledger is also balanced and totaled at the end of each month. We move to step 5 of our accounting cycle. Draw up a trial balance. What is a trial balance? A trial balance is a list of all accounts and their balances or totals. It is used to check the accuracy of the double entry system in the general ledger. It is prepared at the end of each month. So let me explain what does double entry means in simple terms. A double entry system means for every debit amount in the books of the business, there need to be an equal credit amount somewhere in the books of the business. The trial balance is prepared to see whether all debit amounts are equal to credit amounts taken from the general ledger. After checking the double entry system, we move to step 6, which is to prepare the financial statements. Financial statements are used to report the financial position and results from operating a business. The main financial statements are the income statement and the balance sheets. Let us look at the income statement. Income statement determines the profit or loss made by the business during the financial year. It shows all the income and expenses for the financial year and their difference results in either a profit or a loss. So the income statement shows all the income received for the whole year and also the expenses that we paid for the whole year. And we see whether we made a profit or a loss in the business. Then a balance sheet is a statement that is prepared to determine the financial position of the business at the end of the financial year. It shows the assets, owner's equity, and liabilities of the business. So let me explain what is a financial year. A financial year is a 12-month period that is unlike our normal calendar year that runs from the 1st of January to the 31st of December. A business financial year can run in any 12 consecutive months, for example, from the 1st of March to the 28th of February. So a financial year is the accounting period of 1 year, but does not have to be the same as a calendar year. So we come to the end of our lesson for today. Please do complete the activity below on your notebook. Our next lesson will be on the CRJ as to how to enter the transaction into the cash journals. Until then, goodbye for now.